Here's what's coming up on Retiring Well with Michael Reese.
Like a lot of other areas in life, when you have a big change, never a bad idea to sit back and say, okay, we need to reevaluate where we are with our financial planning. You know, if these people held those accounts for 10 years, well, that's $150,000 in fees over 10 years. No wonder they weren't making any money.
Exactly.
I mean, that's crazy. So here's the thing. You need to know what your fees are. You should know what you're paying your advisors. You know, do you want to end up paying tax on a $100,000 account when it's only currently worth $80,000? Or would you rather change your mind, reverse the whole thing, wait a month, and then do it again, but now at a tax cost based on $80,000 versus $100,000?
And now the host of Retiring Well, Michael Reese.
Welcome to the show this week. We have 30 minutes of action-packed information designed specifically for you. So grab your coffee, grab a pad of paper and a pen, because Retiring Well starts right here, right now.
Hi, and welcome to this week's AskMikeCFP.com, where you email your questions into us. We answer them here on the show. Mike, my first question is for you, and it's from Patricia, and she writes, Mike, my husband and I just moved here from out of state. We have our money with Edward Jones because we figured they have an office just about everywhere. When we bought our home here, we realized that our investments were not quite what we thought. What is your recommendation on where we should start to get things reevaluated? Does your firm provide second opinions?
You know, Patricia, that is a great question. The simple answer is, of course, yes. And quite frankly, this is a fantastic time for you to come in for a free evaluation. The reality is you're coming into a new town. You might have different tax rules with your estate planning. There may be different tax rules in the state from where you live compared to where you live now. There's a lot of different things going on. It's a big change in your life, and like a lot of other areas in life, when you have a big change, never a bad idea to sit back and say, okay, we need to reevaluate where we are with our financial planning. So, Patricia, if you come in, you visit with us, we're going to sit down and we're going to help you evaluate. Where do you want to go? What do your retirement dreams look like? What have you done so far? How does that all match up? What are some things, what do we need to do to get you closer to those retirement dreams? What about tax planning? What are you doing with that? Taxes and IRAs. How about your insurance planning, healthcare planning, estate planning? We help you look at all of those things, and I think you'll find it's a different experience than what you might have had at a place like Edward Jones or similar types of outfits.
Larry, my next question is for you, and it's from Steve, and he writes, I have around $500,000 saved in multiple 401ks from various companies that I've worked for in the past. I will probably work another 10 years. What is your recommendation?
Oh, well, good question, Steve. First one would be right off the bat, consolidate. We just had a case not long ago. A client came in and she's basically asking questions, about whether or not she can retire. She's still working, wants to retire, and she's got statements from 20 different companies. She didn't even know what she had. It's probably a good time for him to take all those 401ks, consolidate them into an IRA that now is in one pot, and then start forming some form of a strategy going forward as to what to do with that.
Yeah, it just makes sense. I mean, if you think about it, people always say, don't put all your eggs in one basket, right? And I agree.
Yep.
Don't you agree with that, Larry?
Yep, absolutely.
You don't put all your eggs in one basket, but that doesn't mean that if you hold your 401ks, you put them in one IRA, that's not one basket. That's not what they're referring to. When they say don't put all your eggs in one basket, they're saying, hey, in your IRA, don't put all that money in one investment, like large company stocks or a bond fund or something like that. When you get it there, spread it around, right? Spread it around into different types of accounts. You don't need multiple 401ks and IRAs to spread it around. You can do all the spreading around in one place, but it is certainly a world easier to keep track of what's happening when you've got it consolidated in one space.
Right.
And that makes perfect sense. Here's the other benefit. When you think about your retirement planning, and this was, as I recall, Steve was his name, is that correct?
That is correct.
Yeah, Steve. So Steve, as you think about your retirement planning, think about it this way. IRA, and he's still working, so he's got a 401k, I think he said, is where he's working now. How easy is it to just deal with 2 accounts versus 11?
Sure.
I mean, it's like, let's make life easy on us, not hard.
We like making life easier, right?
That's right.
Mike, Larry, thanks so much. Hey, if you want your questions answered here on the show, very easy to do. Just go to askmikecfp.com. Don't go anywhere. We'll be right back. You're watching Retiring Well with Michael Reese, because your best is yet to come.
Remember when life was simpler? When things didn't move quite so fast, and the world didn't seem so complex? Remember that? We do. And as the world around us has continued to speed up, becoming more complicated and still a bit uncertain, we have managed to keep things simple, providing sound, easy to understand financial advice and customized roadmaps for the road ahead, from tax reduction strategies, investment advice, and guaranteed retirement income you cannot outlive, backed by the claims-paying ability of insurance companies. We can be your single point of contact, a single call, a voice you recognize well, and a partner who can be by your side for the entire journey. We can't stop the world around us, but we can help ensure you're prepared for what's to come. To schedule a no-obligation meeting, simply contact us today.
Hi, I'm Michael Reese, and I would like to invite you and a guest to enjoy a complimentary evening of food, fun, and information with me at our next financial education dinner event. We are going to discuss the important issues that can impact your portfolio and your retirement. These topics include: can you protect and preserve your assets against market volatility? Can you prevent outliving your money? How do decisions in Washington, D.C. affect your retirement? How to make sure that your current advisor is giving you the right advice? Can you find growth and security without risk in today's volatile market? Why getting a second opinion may be the most important financial decision of your life, and so much more. If you are a retiree or pre-retiree in the Central Texas area, then now is the time to take control of your retirement. Call us now as seats are limited. I look forward to seeing you soon at our next dinner event.
You're watching Retiring Well with Michael Reese, because your best is yet to come. Hi, and welcome to this week's Retirement Roundtable, where I'm accompanied, of course, by Mike Reese, the founder of Centennial Wealth Advisory. We have a very special advisor guest with us today, Art Canfield. Good to have you with us.
Thank you.
All right, so I've got a really unique topic, one I'd never heard of prior to the show, and it is, I got to get this right here, recharacterizing a Roth IRA conversion. Mike, tell me what that is.
Well, first of all, we're dealing with multi-syllable words like recharacterization, so clearly the IRS is involved somewhere, right?
Yes.
Recharacterization is a fancy way of saying, I did a Roth conversion. I had money in an IRA, and I converted it to a Roth, and for whatever reason, I changed my mind. So I want to go back to where I was. I want to basically reverse the Roth conversion. When you do that, and you can do that when you reverse your Roth conversion, that's called recharacterization.
And it should probably be called changing your mind, but of course the IRS won't. Hey, listen.
That's right.
People change their mind, Art, right? How often do you see this? I know we're talking about it probably doesn't happen that often, but do you see it from time to time?
You know, it's really interesting this topic has come up, Mark, because it just happened in our office. We had a situation, somebody prior to working with us, a couple, had done a Roth conversion at that time, and it made sense. It made perfect sense at that time. But what happened is their child had an unexpected expense come up and they needed kind of bailed out, right? They needed money. They come to mom and dad for money.
And no kid ever does that to their parents, right?
No, never, right? But what happened was it was a significant amount of money, $40,000, okay? That money they took out of their IRA. Well, now all of a sudden, their income jumped up by $40,000. All of a sudden, that Roth conversion didn't make sense anymore. And now we have a problem.
And there's a limited amount of time where you can do that, Mike. So
Right.
Tell me about that, because you don't have very long to change your mind here.
Well, actually, I would that's what you would imagine. You don't have very long to change your mind. It turns out you might have a longer period than you think, because here's the rule. Let's imagine that you do a Roth conversion during the calendar year. It might be January 1st. You have all the way until October 15 of the following calendar year to change your mind. So if it's 2017 that you do your Roth conversion, it doesn't matter when you do it during the calendar year, you have until October 15 of 2018, the next calendar year, to change your mind. So that it ends up actually offering a lot of opportunities, because another situation that comes up is, and we haven't seen it lately, of course, but what if the stock market goes south? What if you converted your IRA $100,000 from IRA to Roth IRA? But then because the market goes down, you're coming up on October and it's only worth $80,000. Do you want to end up paying tax on a $100,000 account when it's only currently worth $80,000? Or would you rather change your mind, reverse the whole thing, wait a month, and then do it again, but now at a tax cost based on $80,000 versus $100,000? Obviously, the second. So there are certainly some circumstances. The one you gave is a great example, or maybe investing the market going south. Some really good examples where conversion and then recharacterization can both make sense.
So now I've got, let's say, a couple, and they're mind-changing people. Mind-changing people? They like to change their mind, Mike. So they recharacterize, okay?
Yeah.
Can they now convert to a Roth in the future, or that was their one chance?
Oh, you could do it. The way it works is once you change your mind, let's not use recharacterization. Let's just say they converted to a Roth and changed their mind, they went back, right? Well, they have to wait 30 days or into the next calendar year before they can do another Roth conversion. So in our example where they converted in 2017, they recharacterized or changed their mind in 18. In that example, they have to wait 30 days because they're already in the next calendar year. But you can't sit there and do it and undo it and then do it. You can't just keep doing it crazy like that. However, year by year, you may find yourself taking 4 or 5 years before you complete a process, depending on what the market's doing, depending on what's happening in your life.
And Mike, I want to take a second to talk about this book, because that type of information and a lot more great information about IRAs in your latest book, Everything You Need to Know About Your IRA in 5 Easy Steps. How can someone get the book?
It's really simple. When you come in and visit with us, we give you a complimentary copy of the book. Our goal, get good information into your hands. Right? If good people have good information, they can make good decisions. And we understand, I think, Art, it's fair to say, most financial advisors, they don't look at the whole picture, right? They only look at the investments. And you got to look at taxes, IRAs, everything to make smart decisions.
Mike, Art, thanks so much. Hey, give us a call in the office and let's start a conversation. Don't go anywhere. We'll be right back. You're watching Retiring Well with Michael Reese, because your best is yet to come.
Life, a series of moments. A touch, a look, a laugh. Successful people. It might not be superior imagination. It just might be superior retirement planning. Imagine what's next. Plan today, own tomorrow.
Hi, I'm Michael Reese, and I would like to invite you and a guest to enjoy a complimentary evening of food, fun, and information with me at our next financial education dinner event. We are going to discuss the important issues that can impact your portfolio and your retirement. These topics include: can you protect and preserve your assets against market volatility? Can you prevent outliving your money? How do decisions in Washington, D.C. affect your retirement? How to make sure that your current advisor is giving you the right advice? Can you find growth and security without risk in today's volatile market? Why getting a second opinion may be the most important financial decision of your life, and so much more. If you are a retiree or pre-retiree in the Central Texas area, then now is the time to take control of your retirement. Call us now as seats are limited. I look forward to seeing you soon at our next dinner event.
You're watching Retiring Well with Michael Reese, because your best is yet to come.
This week, we're talking about different investment tools that have hidden fees. And if you've been watching the show, you know that mutual funds are particularly guilty of this, and so are things like variable annuities. But John, why don't we go a little deeper here and let's share with the folks watching the kinds of fees that we're really talking about here.
Yeah, so let's take a look at a recent example of someone who came in with $500,000, and they had come in originally curious about, hey, why am I not getting the returns that I would expect to get with these different investments? And so we started digging into that and finding out, okay, what are the costs behind these investments? Because that obviously plays a major role. So with mutual funds, there's a way that we can dig behind the scenes and understand what those costs are, and there's going to be some reported in the prospectus, right, that they're going to show you those, and then there's a section where we may not actually know exactly what those costs are, but we can get a reasonable estimate on the mutual funds.
So what he's talking about there is that with mutual funds, you have fees that you see. Those are outlined in the prospectus, and you don't really see them in a statement, right? I mean, they're all hidden in a statement, but you can look up in a prospectus and actually see what those fees are. But there's another level of fees where you don't even see them. They're all hidden. They don't have to report them, so they don't. And then when we have things like variable annuities, you have all those mutual fund fees we just talked about, but then there's another layer of fees. What are those?
Yeah, because you're working with an insurance company, there's mortality and expense charges that they're going to have. And so those can be 1%, let's say, in this example. And then beyond that, then if they were to have, in this case, they had an income rider, which simply means that they're guaranteeing some type of future income from that annuity.
Okay, so here we had, as I think you were saying, these folks came in, they had $500,000. Was it in one of these variable annuities you're talking about?
They had a combination of both, yes.
Both variable
50-50.
annuities and mutual funds. So they had both, some of it was in variable annuity, some of it in mutual funds.
Right.
How many of the, now when they saw their statements, did they see fees anywhere in the statement?
No, most of those were not shown. There were like these $30 per year annual charges just to have the account, but minimal.
Did they have any idea at all as to what they were being charged?
No.
None. So when you did the research, when you dived in and you said, all right, let's take all this apart and let's figure out what they're being charged in, in all these different types of accounts, what did you learn?
Well, we saw on the mutual fund side of the portfolio, they were around 2.5% per year is what they were paying there. And then on the variable annuity side, it was closer to 3.5%.
So if they had half and half, that's like 3% on half a million. That's like 15 grand a year, right?
Yeah, and that's why they were wondering, we've been looking at our account statements and it doesn't seem like we're growing quite as well as we should. We're only averaging, in this case, about 3% was the return, and ultimately we came back to show them why it was those costs.
Now think about that, folks. Think about that. $500,000, $15,000 a year in fees. If these people held those accounts for 10 years, that's $150,000 in fees over 10 years. No wonder they weren't making any money.
Exactly.
I mean, that's crazy. So here's the thing. You need to know what your fees are. You should know what you're paying your advisors. So, hey, if you have questions about this or anything else we talk about on the show, please feel free. Pick up the phone, give us a call, or visit the website.
You're watching Retiring Well with Michael Reese, because your best is yet to come.
Having no clear retirement plan is a mistake I see a lot in our financial planning office when we meet with someone new. It is extremely rare that someone comes in and has a clearly defined income plan for his or her retirement. If you don't have a clear retirement plan, then be one of the first 5 callers, and you will receive a free Centennial 5-star analysis. There's no obligation and no cost if you have at least $250,000 saved for your retirement. Here's what you'll receive: a free report that tells you exactly what you're paying your current money managers, both what you see and what you don't see. A tailored plan to safeguard your investments from market volatility. Tax analysis to reduce liability and increase cash flow. And a custom income plan to boost your retirement. So call now for your free, no obligation Centennial 5-star analysis. And remember, you only retire once. Let's make sure you do it right the first time.
You're watching Retiring Well with Michael Reese, because your best is yet to come.
This week in CFP Talk, we are going to talk about risk, and specifically the question, how much risk can you take? Now, CAN is, of course, an acronym, and we're going to talk about what that really means. So when it comes to risk, and whenever you talk to financial advisors, you go online to, say, a Fidelity, Vanguard, Schwab, one of these places, one of the first things they do is they give you a risk profile questionnaire. And there's a reason for that. The reason is what they're trying to measure when they're asking you the questions on that questionnaire is they're trying to measure something called your risk capacity. In other words, they're trying to ask the question, how much risk can, what is your capacity to take risk? In other words, how much could you handle, if you will, provided that, of course, all things go well. Now, let's imagine, and this is where, and you know what I'm talking about here, this is where, they're trying to identify, are you a conservative investor? Are you moderate or are you aggressive, right? That's what they're trying to find out. I know you know what I'm talking about because you've done this probably 100 times by now. But here's a big disconnect, and this is where people get into trouble, because it has to do with the difference between capacity and what flows below. Because this is what you need to understand. As far as a discussion on risk goes, the financial industry, as far as they're concerned, all the discussion begins and it ends with that, capacity. We did the risk profile questionnaire. We know your capacity to take risk. We build a portfolio that matches that. We're done. They have covered their backside. If things don't go the way you want, you can't sue them because they can come back and say, nope, you told us we could take this much risk with your portfolio. Now, this is where things change for those of us who are fiduciaries. Now, our firm is, of course, a fiduciary firm, and for us, we feel we have to dig a little deeper. So what is the A? A stands for attitude. What's your attitude? I just gave you an example. Up here, they're trying to find out what? Are you conservative, moderate, aggressive? Let's imagine that you decide you're moderate. You're moderate. And we always ask a follow-up question like, okay, great. What does that mean to you? How much do you feel you can lose in a single year? And what's your willingness, your attitude about losing money in a single year? And you might say, I'm a moderate investor. It's okay with me. I'm willing to lose 15% in a single year. Let's pretend that's you. But up here, what you don't know, dirty little secret of the financial world, if you are a moderate investor, they're assuming that you should be happy to lose 30% in a single year because that just happens sometimes. That's what a moderate investor is in these risk profile questionnaires. Do you see a little problem going on here? Yeah, it's a little problem, isn't it? There's a third level, though, because as a fiduciary, we're still not done. We got to dig a little deeper yet. What does N stand for? N stands for need. The question I would ask is this: how much risk do you need to take to make your financial dreams a reality? What if you can make your financial dreams a reality at a 5% rate of return? What if 5% is enough to make all your dreams come true in retirement. You know what we do as fiduciaries? We say, okay, if that's what you need, here's our question. How much risk do you need to take to get to that number? Can I get to that number within that 15% wiggle room? Can I get to that average return and not take more than that kind of loss? If I can, fantastic. We're on target, right? Or do I have to go up here? Where are we? You see, people get into good people, just like you, they get into trouble in retirement because why? The industry has labeled you as something, conservative, moderate, aggressive. They have what you don't understand. They have certain expectations of people in that capacity level. And guess what? I'm still waiting for the first person who calls themselves a moderate investor as they're getting close to retirement and says, yep, I'm willing to lose 30% in a single year happily. I don't get that. We get people saying, no, I'm moderate. I'm only willing to lose 10%, 15%. The definitions don't match up. The core understanding does not match up, and that's what gets you into trouble. Make sure you're talking to someone that understands this stuff. Now, if you have any questions about this or anything else we talk about on the show, please feel free. Give our office a call, come visit with us, or visit our website.
You're watching Retiring Well with Michael Reese, because your best is yet to come.
You made it. Years of hard work, investing, planning, and now you're here. The long-awaited reward you spent a lifetime looking forward to. But what now? After years of growing a nest egg, now you may want to manage it. Use it to fund your dreams. Make it last as long as you need it. And leave some for those you love. So what do? Wall Street continues to be uncertain, and some conservative options have dropped through the floor. How do you maintain opportunities for growth and reduce risk of loss from market changes? That's where we come in. We are financial professionals. From investments and insurance products to tax reduction strategies and guaranteed retirement income you cannot outlive, provided by the claims-paying ability of insurance companies. You've worked a lifetime to get here. Let us help you enjoy it to the fullest. For a complimentary consultation, simply contact us today.
You're watching Retiring Well with Michael Reese, because your best is yet to come.
Thanks for watching this week. Now remember, if you have any questions about anything we talked about or anything about your retirement planning at all, please feel free to call us, come visit with us, or visit the website. Remember, you only retire once. Let's make sure you do it right the first time. We'll see you next week.